If you are a trader and you wonder why price always hits your stop loss despite a perfect analysis on your chart, this video is for you. Stick around, hit that like button, subscribe, and let's get started. Liquidity sweeps happens often on trading. Think of it like this: when you set a stop loss just above your resistance level, you are not alone. Thousands of traders do the same. A liquidity sweeps happens when price dip above that resistance level, trigger those stop orders, and then reverse back down to your initial direction. Sneaky, right? At the end of this video, you will get to know when to buy or sell so you won't get swept again by market. So all you need to know to tackle your trading flows resulting to multiple stop loss hits is your BSE strategy. BSE means buyers, sweep, and entry. In this strategy, you don't need indicators, trend lines, nor support and resistance. All you need is your daily buyers, liquidity sweep, and a perfect entry. Step 1. Use 4-hour time frame to identify your daily buyers by knowing your most recent market trend, because market only moves for liquidity. Those who move market, including central banks, financial institutions, corporations, and hedge funds, target higher time frame liquidity. And this here is the most obvious 4-hour liquidity in market direction. Since you already have your daily buyers that market is after the 4-hour liquidity below, then on your lower time frame all you'll be looking for is to short, cause you don't want to trade against the trend. To add more confidence to your trades, identify fair value gap or order blocks to see if market is respecting or disrespecting them. If market respect them, then you have more reason to sell. Let me set an example with this chart. If price drops down trying to retrace up like the fair value gap magnetizing price and price withdrew it, then that's obviously a sign of disrespect. Market will keep trending up. But if price just come and tap on the fair value gap just as it did now and drops aggressively, then they are still selling pressure. So all we want to be looking on lower time frame is to shorts. Our second step is liquidity sweep, and don't forget this is a live market. Our first step is daily buyers. Our daily buyers is the 4-hour liquidity down below, so we'll be selling, and the second step is liquidity sweep. You see this high here, that is what we were waiting for market to sweep. You see, and market swept the high, and now we'll be looking forward for our entry. And for a better entry is either you use Fibonacci retracement, order block, or fair value gap. For me, I mostly use fair value gap. The first fair value gap that appears is your point of interest. Whenever there is liquidity sweep, market print aggressive candles in the opposite direction of the sweep as fake move. Market will retrace back to give smart money an opportunity to sell using fair value gap, order block, or Fibonacci level. But on this example, I'll be using fair value gap. You see, when market retrace back up and hit my entry, that's my first fair value gap market created after the sweep. It immediately started printing an aggressive bearish momentum candle with an almost zero drawdown. I mostly aim for 3-to-1 risk to reward for consistency and higher win rate. My stop loss is always fixed at the immediate high of the liquidity sweep. That is it, traders. If you master this high probability trading setup, then your previous problem of liquidity sweep or stop loss getting hit has come to an end. And with this, I would like to say thank you for watching.